just wanted to say that I suggest everybody to read the letter. It's a really interesting letter. Especially I like the whole letter, but I especially like the towards the end of it where he describes a little bit more regarding the history of the monetary system and also the history of mining and some other things regarding Mark Twain. Which after seeing his picture of that mustache, maybe I need to grow one as well. All right, let's get started. Something that came to my mind, Kevin, as I read through the your idea regarding or the history of the Chinese inventing fiat currency or fiat money, I should say. Um, you know, it's interesting because it reminds me a little bit of the crypto space. It's not to say, a lot of people think that when you're not necessarily a supportive of the idea of Bitcoin, for instance, is as a standalone currency to compete with gold, for instance, let's say. I think we forget that we did go through a fiat revolution during that time. I mean, economies and governments went through a long period until today where fiat money is still used in a big way. Now, not having a view, or at least not having a positive view about Bitcoin as a currency, isn't necessarily a view that we won't see digital currencies. I actually think that's going to be highly likely, but it's just to me, it's just much more of a byproduct of excessive liquidity and valuing something towards an encryption reminds me of valuing something towards the hope of having physical gold to back a currency. I mean, that's to me what it sounds like. And I'm not a I much rather own gold. And this is not coming from a person who's a gold bug. I am not a gold bug. I believe in gold first and foremost because of the macro reasons that we should be owning gold today. Because I appreciate history, number one, and looking back and understanding how assets tend to go to cycles, especially secular cycles. I just have a very strong conviction that we're going to through another secular movement for gold, and when those check, usually you have uh, a domino effect in the macro space, and that's what this presentation is going to be about. There's something that I notice about commodities is the fact that you usually, when you are in a commodities bull market, you tend to go through a rotation, and it's remarkable how this tends to unfold because this rotation essentially is also happens in the media overall. Basically, there's a commodity that is more prominent in terms of narrative, and I can recall back in 2021, this happened with lumber. Lumber was surging in prices. And then what did we see? When lumber prices began to plunge, the media came out saying inflation is over because lumber prices are back down. But what they miss was the fact that it rotates. And this becomes, it's not a unique effect. It really is interconnected across all commodities. And so once one starts to fall, the next one starts to rise. Recently, we had this phenomena happening with orange juice. Orange juice went up significantly, then declined, and now cocoa is the next one. Cocoa was basically making new highs, levels we haven't seen in many periods in history. And now it's coming back to earth. And guess what? What's happening now? Natural gas prices are starting to rise and nobody is paying attention to it. Let's go to the next chart. And to me, this is one of the most asymmetric opportunities in markets right now when it comes to this commodity rotation approach. You can look at this in different ways in the natural gas prices. I think last week, and I'll have this chart in the following slide that shows that we're basically retesting a major bottom, meaning we've been here before, and the times we've been here before marked major bottoms for natural gas prices. Now, one thing that is important to look at is the futures curve. So you have a natural gas contract in the futures market, and you can look at the spread between what is the current price versus the price a year from now. In this case, actually, I'm looking at the other way. I'm looking at the price that is going to be a year from now versus the current price. And when you have a contango, so there's a contango in backwardation. Backwardation means that the future price is lower than the present. And a contango means that the future price is higher, or the longer dated contract should say, is has a higher price than the present or the front month contract. In this case, this is exactly what's going on. Now, if you dated this, if you go back and look at, what were other contangos in history, using the word contango in plural here, clearly that also marked a bottom for natural gas prices as well. Well, that's really interesting because this is the second steepest contango in history. You know what this reminds me of? Oil prices. Back in April of 2020, oil prices had a ton of inventories. We had a flood in the markets. People were saying that oil prices would never go back up, and we had negative prices in WTI. And guess what? The contango of oil prices during that time was also quite significant. The main reason for that contango, in fact, was cause futures and the long dated contracts were starting to rise, but also we saw a huge decline in the front month contracts. That reminds me of today. That is not to say that inventories are not, flooding the market today for maybe political reasons, maybe just the case. But when I see this need for energy, electricity, the shortage that is likely to come from electric cars and electric heating and the AI revolution, and seeing CEOs of natural gas companies come out and say, look, I mean, the demand is going to be exploding here if we don't do anything about this. This to me is quite concerning, but also a way to express that view in the markets that I think it's quite mispriced currently in markets. If we go to the next chart, that shows the chart I was referring to, which is those bottoms in the past. And if you go to the next one, it kind of shows where those appreciations that came about after hitting those bottoms. And we've had some quite significant numbers here in terms of the appreciation. And interestingly, what when I look at this price and this relationship of with history, first thing that comes to mind is, how do you express that view? Is in the equity markets? Should we be buying the commodity? And we have a view about energy companies. We think energy companies are exceptionally cheap, especially from a free cash flow perspective, how much they have in margins and so forth. Can go on and on and on, and why we think that the energy space looks historically undervalued. But it's hard to find a natural gas producer that looks like this chart. Yes, they're cheap, but none of them look like this chart, meaning literally in the dumps when it comes to looking at the historical price chart. Now, if you go to the next chart, the other thing that comes to mind is the fact that even if you looked at, it's coming from a person who is also bullish on oil. I actually think, just like most commodities that are chasing the Russian invasion high levels that we had in June of 2022, while the invasion happened 1 or 2 months before that, with prices really reached a peak back in the June of 2022. If you notice, a lot of commodities have been chasing those levels recently, and I think we're going to go there across most of those hard assets. And interestingly, even relative to oil prices, you can see clearly nat gas is really cheap. The prior time that we saw this oil to nat gas spread, what we call this BTU spread, because it's adjusted by on a BTU basis, you can see here that the prior time was actually in 2012 in April. And if you just go back one chart, if you don't mind, Nathaniel, you can see that back in 2012, we saw basically a very large appreciation of natural gas prices coming out from there. And I actually think that is very plausible to see something like that today. It's just my opinion. And so at Crescat, we're actually long natural gas future contracts. And people ask me, how do you do this? Well, if you look at the long dated contracts, and that's a function of the fact that we have such a large contango, they have started to move already. And so we're not necessarily long the very first, the next month, front month, but certainly the shorter dated contracts are the ones that we think look more attractive today. So let's go to the jump two charts. There we go. Well, I talked about this phenomenon that is happening today in markets as well, and there's always something that is somewhat illogical, and it doesn't sound rational in the macro world, and to me that's one of them. And I talked about, we all maybe agree that there's a new era of interest rates, while 2 years ago that was very difficult to make that case. I think today a lot of people would agree that interest rates are likely to stay higher for longer. And that's really on the back of many things. It's not just inflation. Inflation is a huge component of that, but also the large amount of issuances that we're seeing in the treasury markets. And you can go back and see some of our research back in 2021. And so we were talking about this, the risk of issuances is starting to cause interest rates to rise, especially in the long end. Now, what we haven't seen yet is if you're a company borrowing capital at 4%, and now you're borrowing capital at double that amount, which is the case in the junk space in particular, I would say that the risk for default of that company should be rising in tandem, and we just haven't seen that yet. So this is one, the white line there, you've seen this, is the credit risk, is basically looking at the credit spread between the corporate bond versus a risk-free, supposedly, or the treasury market interest rate. And you can see that the differential between the two are one of the lowest we've seen in history. In fact, depending on the spread, is one of the lowest we've seen in 3 to 4 decades, which is sort of shocking, really. Let's go to the next chart. And so what's happening as well on top of all this is that we're starting to see some reacceleration of inflation. It started with most of commodities. We talked about this potential for a second wave. And that sort of started happening indeed. And now we're seeing this starting to also unfold in the housing market. Interestingly, if you look at the house prices, they began to actually rise again. And this is, by the way, is very similar to commodities. We just have not fixed the structural problem of the housing market, which is shortage of inventories. We're going to have to build more. But in order to build more, we need more materials. And in order to get more materials, we need more commodities. And commodities have been through, as we all know, a long time, a chronic decade or so of underinvestments, and which is also causing this constraint of supply. And so how in the world do we fix the inflation problem from a housing perspective or commodity perspective? Well, we need to either build homes or create a massive crash in the economy, which I don't think that the Fed will allow that to occur in a large way that we saw back in 08, because we have the printing press today. So that is even more likely to happen. So if we go to the next chart, despite all the concerns about the housing prices, we're seeing the housing market basically climb a wall of worry. This is the month-over-month prices of houses in the U.S., which I know I'm onto something when I tweet something and nobody really enjoys it. And that's the thing that really catches my attention, because I know this is a big problem. It's rising at about 12% annualized rate if you look at this chart. If you take away the pandemic-related surges that we've had in 2021, 2022, look, you can see clearly that this is the largest month-over-month increase that we've seen in the history of this data. This is government data. For those that believe that government actually suppresses inflation and so forth, which I'm in that camp, by the way, I do think government data is understating what the inflation number really is. Well, think about this. This is actually government data showing you that month-over-month housing market is growing at 1.2%, which annualized will give you a double-digit number. So keep that in mind. And this is such an important chart. How do you fix that? We got to build homes. And this is, to me, it's also a critical part of our own commodity conviction in terms of the thesis moving forward. That is not to say reshoring and green revolution won't be also a huge part of this, but this is an important component of that thesis as well. Let's go to the next chart. I thought this was interesting because that was a news on Insiders. The Biden's top economist says that the key to ending the housing crisis is giving cities and developers monetary incentives to build more affordable homes. Now, I don't care political views, but that's probably what's going to end up. I mean, there's a reason why Warren Buffett owns home builders. It's because I think it's way ahead of the curve on this, and most likely we're going to have to see a boom of construction before we see some issues emerging in terms of prices. Let's go to the next chart. And to me, this is going to be why inflation will be sticky as well, because housing is a huge component of inflation. And if you think about how much we as consumers spend on housing as part of our paychecks or whatever you have, your wealth, it certainly is a big chunk of all of us. And to me, this ties back to a macro idea that we've been talking about in this presentations for a while, which is the idea of the steepening of the yield curve, which recently has started to gain some momentum on the upside, caused mostly, I should say, not really by the 30-year yield rising, but really because the 2-year yield has been declining. Today was one of the largest declines in the two-year yield that we've seen in many years. By the way, when the yield curve starts steepening again, that's usually a sign of a recession, especially when you're coming from deeply inverted levels. And I think that will be the case again. I don't think this is I often think about, if we're looking at yield curve is inverted, it's starting to steepen. That's a recession sign. And you look at unemployment rates that came out today, in fact, and is starting to rise as well, clearly in a year-over-year change of growth to the upside, clearly. What does that mean? That means that we went from everyone pricing in the curve that the Fed was going to cut rates by 7 times to basically close to 1, and now we're back to 2 or 3. I think we can see more cuts personally. When I see that move in the market's expectations, I tend to take the other side of it, and I think there's reasons for it, and one of them is the potential for a recession. And I know inflation is hot. I think most of I'm of the view that inflation is here to stay, but we're probably in a stagflationary environment. In a stagflationary environment, the Fed doesn't have much that it can do, and so cutting interest rates and finding reasons to cut interest rates are probably going to be easier moving forward, because I think we're going to see some level of weakness coming from the fact that interest rates are already at very high levels, and the system just cannot endure those types of cost of debt and cost of capital overall. Let's go to the next chart. And so here's an interesting thing, because we're seeing earnings coming out, and I pay close attention, and Crescent pays close attention to earnings too. We go through different ways of looking at sectors and industries that we think look interesting on the long or short side, and what we're seeing in terms of the commentaries. Some of my points would be, looking at a lot of the discretionary companies. I find it interesting that affordability is starting to become a problem, and that's a problem also in the housing market. Not to get there again, but it's really interesting that we're starting to see some of those commentaries begin to show that. But look at the divergence of diluted earnings per share between large and small caps. I mean, we all know that large cap companies have been leading the market recently, but it's interesting as well if you dive in deeper into the fundamentals of those two segments of the market. You can see clearly that the red line, which is Russell 2000, smaller companies are definitely in a contraction already in terms of a trend of their earnings, and we're still seeing the S&P 500 companies seeing an upward trend, and you can see that back in 2019 that was the case as well. The small cap companies led the way to the downside. Large cap companies were up in terms of fundamentals. Oh, look back in 06. I think actually 05, 06 was also the case. Guess what peaked first? Russell 2000. The small cap companies, they're peaked. And then later on, we had the large cap companies peaking. And one phenomenon that didn't happen was in the early 2000s. We actually saw both having this issue together. So I'm paying close attention to this, because I'm not as bearish on small caps, because I can see small caps actually outperforming moving forward. If you study what happened in the 70s, small cap companies actually outperformed large cap companies, which in today's environment would be unthinkable. But remember, markets like to do things that are outside of the conventional wisdom. That was the whole point of the prior presentation. And so it wouldn't surprise me if the next 10 years is an incredible decade for small cap companies, which is, I guess, one of the reasons as well why we feel comfortable investing in small cap companies in the mining industry. Let's go to the next chart. But pay attention to this, because majority of the employment in the U.S. economy comes from where? Comes from small cap companies. Only 18% of employment comes from the S&P 500 companies. If you look at this data from Apollo, and so as you see this contraction of fundamentals coming from small companies, you should see some reflection of that into the labor markets, which should be starting to show some weakness. That's what we're seeing as well. Unemployment rates are starting to rise, and that's probably just the beginning. Unemployment rates, when they cross their own 24-month moving average, it's a 2-year moving average, they never look back. They usually go up from there. This is what history shows us. It's not my opinion. We've never seen a time when unemployment rate crossed the 2-year moving average and actually crossed again on the way down. No, that never happened. Usually we tend to see is an upward trend in unemployment rates, that from there you tend to see a deterioration of the economy as well. So, this is why when I see that small cap companies are actually struggling, most likely this is going to be impacting labor markets too. Let's go to the next chart. So you can see here that, I don't like the title of this chart. It's from Jeffries. Great chart, by the way. But it basically shows, and the reason why I like this chart is because it goes back to the 1930s and shows you that throughout history, this is one of the lowest times that we've seen the percentage of small cap companies relative to the total market. So, no, that is very much in line with what we are seeing as well in the mining space. I mean, certainly the mining industry has got no love, especially the small cap companies. And this is a translation of that too here in this chart, showing that usually that's unsustainable. We tend to see this to be a secular move as well. Back in the 70s, as shows in this chart, we had a huge move, or the small cap percentage as a total percentage of as a total part of the market cap, it started to rise during that decade in a large way. And I think that will probably be the case here again. Let's go to the next chart. And you can see here too, through just looking at fundamentals, so valuation, the PE ratio of a small company versus a large company, it has the steepest discount that we've seen in the history of this chart. And going back again to the 70s was a great time to be invested in small companies versus large cap companies. And back after the tech bubble in the early 2000s also coincided with where we are today in terms of valuation. So, where do we go from here? Well, we'll probably, if given our views, is that small cap companies are likely to gain some momentum on the upside. By the way, this is not, it's all linked. It's emerging markets, it's commodities, it's small cap companies, it's emerging markets, foreign currencies, their bond markets. Everything is sort of moving in the same direction. And I think they're going to start taking leadership more and more over time. And we saw some of that with energy companies, the value to growth rotation, which I'm going to touch on this. You go to the next chart. You can see a similar research going back as well to a few decades all the way back, and you can see here clearly that there's also secular changes between growth to value. The rotation of growth to value also tends to unfold in a secular manner. We saw that back. So the blue line is declining. That just means that basically value is underperforming growth. Recently, we've seen basically a bottom of this trend where value started to outperform growth. This is mostly driven, again, by industrials, some energy companies. We saw some other commodities actually doing well. Even copper producers are starting to perform better. And this is slowly, things don't happen quickly. I mean, they slowly start to spread around, and you start seeing those types of outperformances occur more often. And therefore, this blue line starts to go and solidify an upward trend. So in our view, this is probably going to be the case. I think Kevin had a good retweet over the week that I thought was interesting. That a whole thought about how growth companies usually never realize that growth that is expected by analysts, and that's an interesting thought. We usually see that in emerging markets. In fact, emerging markets are emerging economies. Brazil has been an emerging market since I was born. Never emerged to be a developed economy, and it probably will be the case when I die. So it's just it is what it is. We're probably never going to realize this whole idea of emerging to a developed economy, but that's just what it is. Let's go to the next chart. This is another way of thinking about the same idea, just looking at the P ratio of value versus growth back in the tech bubble. And I call it bust. It should be bubble, sorry. But the tech bubble environment, we also saw the value to growth PE ratio differential being very historically out of line. And clearly that was the case. Value was very cheap relative to growth. And we saw this actually in very similar levels back in peak of 2021, in which in some metrics we're retesting those levels in terms of how expensive the market is right now. But really, I think this is a trend that as you can see in the prior trend, when we reach those lows, we tend to go to a period where value tends to outperform over time. And I do think that will be the case again. Let's go to the next chart. You can also see that even from a cost perspective, as you increase the cost of capital, investors tend to start thinking more about profitability. And that's the whole reason why actually in an inflationary era where you see hard assets rallying significantly, inherently improves your pricing power. And therefore, commodity businesses actually tend to have higher profitability during inflationary eras, not all the time. And so in this period right here, you're seeing 10-year yields rising and people continuing to value growth more than actually value stocks. So you're seeing here, the white line really is the global value versus growth stocks, and the blue line is 10-year yields. And you can see here that the blue line is rising. You would suspect that the white line is going to start following along, which means value investments is starting to outperform growth investments. Let's go to the next chart. Brazilian equities would be a good example of that. It's in line with the fact that we've seen small caps underperform and value underperform. Emerging markets are also part of that. And so you're seeing Brazilian equities recently, basically poke their head out of this major resistance, which is probably a few decades resistance, as you can see in this chart. And after breaching that level, it actually retested that level again, which is usually in a technical world that tends to happen actually. And now people lose the belief that this is an actual trend, but usually what we tend to see is the continuation on the upside. And so this is why I tend to be very bullish in Brazilian equities overall. I think most of the pessimism is already priced into the valuations that we're paying for those companies now. Let's go to the next chart. Let's dive in a little more into the commodity space here in a second, but the technology companies as well. And you think about more broadly speaking on the 60-40 portfolio. 60-40 portfolios, when you think about the 60 portion, which is equities, majority of that is coming from technology companies. And it's kind of scary to see that the correlation between tech and treasuries are so high, because they are basically relying on the treasury side of the book to save them when tech stocks don't do very well. But the correlation between those two segments of the market have never been higher, or maybe it was higher, as you can see in this chart, back in the early 2000s. And actually, I like this chart, but I don't like it that much, because the early 2000s wasn't as comparable to today in terms of the inflation problem, which is, I think, should be a little bit more emphasized here, given this idea of treasuries research, because the treasury market is going through something that resembles what happened in the 70s, in the sense of central banks actually accumulating gold rather than treasuries. And that's what's causing this issue. But as we see interest rates being pressured higher because of the selling pressure coming from central banks and or other institutions, and inflation and supply and so forth, ultimately it should also have an impact on the technology companies' valuations too. Let's go to the next chart. And so a phenomenon is happening now that is important to notice, is what's happening with Japan intervening in their markets, trying to prop up their currency. I've shown this chart before, where it shows the devaluation of the yen versus the rising inflation expectations. This is not a Japan only sort of phenomenon. This is happening globally, where we're seeing the rise of inflation expectations. And even with that, central banks are struggling, coming up with ideas to really be able to stop inflation from rising, from developing in their own economies. And as a result of that, we tend to see the devaluation of fiat currencies. This is why commodities have been doing so well, and probably this is the beginning of a trend, not the end of one. Now, I thought, an elegant way to describe what's happening is maybe in the next slide, in which Ronnie had this tweet. It says the biggest piece of M&A in the past 12 months was the merger of the Treasury and the Fed. And this is a quote from Michael Hartnett. And I thought that was a great quote. I thought that was a clever quote, because it's happening not just here in the U.S., but it's happening across other developed. Of course, it's not a real M&A or anything like that. Don't take this. It's more of a figuratively rather, but it's an interesting way of a concept to explain the situation quite well. Let's go to the next chart. And so if you look at the S&P 500 in gold terms, we've gone sideways since 2017, actually. And while I'm not a real technical analyst, I just can't help myself but look at this massive head and shoulder formation that has been happening since 2017 or so. And you can see here that suggests that maybe this chart, the white line, should actually be going lower as we see gold outperforming. It's particularly interesting, this chart, because this whole idea of the S&P 500 declining relative to gold terms is something that happens quite often after we see yield curve inversions. And so we've done deep researches on this, and research pieces on this, and certainly that's the case statistically, and I think that will be the case again today. Let's go to the next chart. But more interestingly, you can see this across the other commodities. It's not just the gold, the S&P 500 in gold terms. So look at the oil relationship versus the S&P 500. This is such an interesting chart. You go back to the 1930s. It's really hard to find a time in history where oil has been this cheap relative to the S&P 500. Now you can say, well, it's not a fair comparison, because S&P 500 is measuring the performance of companies that have cash flowing vehicles, and that's fine. But throughout history, we usually retest those levels, and we tend to see upward momentum in this chart, in which I think will happen again. And we tend to see this over history. In the 70s was the case, in the early 2000s was the case as well. I think certainly we're going to see this again in a commodity cycle. Let's go to the next chart. And so you can see here the price of oil adjusted for gold, which is really interesting. There's times when it gets historically expensive, times it gets historically cheap. Now, while we are gold bulls, it is interesting that oil is also really cheap historically right now, relative to gold as well. So this is an interesting idea, because as you can see here, there's major bottoms in the past. This chart goes back to the 1920s, and oil relative to gold, as you can see clearly here, have shown many times that it can actually hit a major bottom and start an upward trend. It's probably going to be the case here again, with the supply side being such difficult situation as well. Let's go to the next chart. And you can see as well with copper prices. Now, there may be a reason why we haven't seen true inflation as much as we saw in the 70s, and beginning to see now, but in the last decade, is the fact that most commodities have actually underperformed gold, have underperformed the metal, and I think gold is a great proxy for inflation. So copper actually has is trading currently in the same level it was trading back in the 90s in relative to gold. Now, if we think that gold is entering a bull market, imagine what's going to happen with copper prices. And maybe the next chart is even more interesting because it shows a a sort of head and shoulders, inverse head and shoulders of copper adjusted to gold. But if you go to the next chart, there's a guy here in this presentation that really likes zinc, and zinc is also, if you look at zinc in gold terms, oh boy, I mean, this is one of the lowest levels we've seen in the history of the metal, and also looks really attractive. Look at what happened in the early 2000s in that ramp up in prices that we saw relative to the metal as well. Let's go to the next chart. And you can see as well the mining industry relative to gold also looks the same way. We've been in a downward trend. A lot of people have lost faith in this chart. It kind of looks like the Brazilian equities chart as well. And all of those are probably prone to or poised to a major breakout. As we see that happening, it probably will unleash a long-term trend. And that's the whole point of this chart. And I think we're so close to something like that, very meaningful. A lot of people have lost faith on the potential for such appreciation. And I think we're long overdue for one of those large appreciations that we tend to see along with gold prices. Gold prices went up a lot recently. Now we've taken a break. It's nice to see that we didn't really see a crash in prices in this recent break in gold prices. And so it makes me think that, and also on the days that gold prices were down, we actually saw the mining stocks do quite well, which makes me think that we're getting really close to something very meaningful in this industry. Let's go to the next chart. I'm almost done. And you can see here the valuation, which is where we really lean our research on, is looking at valuations. And this is an interesting chart from Financial Times going back in history of the price versus the net asset value of the mining companies trading at lowest levels in 40 years, which to me is another way of thinking about this opportunity on the long term. I think this is my last chart, but two more charts actually. This is the metals and mining industry, just looking at transactions of M&A. Look how interesting this chart is. I know we've seen back in 06, 07, we've seen a very large amount of M&A transactions. We're starting to see the pickup of M&A. And 2021, we actually have 0 transactions during that time, which only happened back in 1995. We're starting to see some of those. But remember, the major companies are facing a problem of especially the gold space, where ore is deteriorating in quality. Average grade is in a declining trend. And so we're likely to see more M&A transactions happen. You can see this in dollar terms, or you can see this in number of transactions, which is the next chart. If you look at the next chart, you can see number of transactions, also an interesting one, in which kind of resembles this beginning of the early 2000s when things kind of picked up from there. So, we're just at the beginning here. This is what this chart shows. And those are transactions that were completed above $1 billion. And you can see clearly here that this is probably just the early stages of that, as we see the miners starting to make money and finally be able to move towards M&A and other types of decisions that they may make.